Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through social media on Twitter, see what people are sharing. Obviously, I'm going to interject my financial opinions as we go. It's going to be commodity, wealth building, and financial related topics that I mainly cover. And don't forget, if you guys need any help with anything, check out finding-value.com. Join our community where we talk about individual companies and all this stuff. And I can interact back and forth with questions that you ask me. So let's dive in and see what's going on. So let's go into Patrick Downs' thoughts on the uranium trade. I know uranium's heating up today. Today being 10/31. This is being released November 1st. But let's talk a little bit about uranium. So this is his thoughts that he shared with a few people privately. He said they think they understand the thesis, the trade, but they really don't understand just how tight and how coiled this trade is and how limited supply is outside of basically two companies. Broadly speaking, the uranium trade is viewed by many, not all, to be a pump and dump based on, I suppose, confirmation bias from the last U-bull market. But we have an entirely different setup today than in the 2000s. Specifically, no real new supply is coming on. Most junior uranium explorers, developers, are still massively undercapitalized. You need only look at the following list and cash balances of ASX uranium stocks. Of the developers that can bring on pounds in the next 5 years globally, there is likely only a couple of possibilities. Spot at 75 or 100, it doesn't address any of the challenges to uranium supply in the short to medium term. The issue isn't spot price. The issue is underinvestment over a decade in new mines and new greenfield exploration. So number 5. So in summary, many think if spot goes to 100 to 120, supply problem is solved. No, it's not. And most brokers, fund managers, when asked about uranium, think the supply issue gets solved quickly at $100. Hint, it doesn't. It's going to take time, not just higher spot. Stay long. I like it, guys. Very similar thoughts to what I think. Very, very similar. It's not about price. It's about the situation that the uranium sector's in with getting new pounds to production. It's about increasing supply and the time frame of increasing that supply. Completely agree. Yellow Bull says, we are at the start of a contracting cycle with several pockets of demand from bigger utilities still to come, says Grant Isaac. We are already at the highest number of contracted pounds of uranium in over a decade, with 145 million pounds locked in, and momentum is increasing. Rick Rule says, in uranium, the easy money has been made. The real money gets made now, and the big money gets made when it gets stupid. Yeah, and then getting stupid, we'll see when that comes. A lot of people are trying to pinpoint that, but I'll just say it'll come. The price of uranium could easily move $2 to $3 with only 500,000 pounds purchased. Once capital will flow into financial vehicles, we could see huge spikes. As per Asker Betrobiev, I butchered his name, I'm sorry guys. When I spoke to him yesterday, the market is extremely tight. I will upload the chat on Friday. Lobo says, Pet, the bigger fish are starting to nibble at the uranium stocks. I expect bigger moves when the whales bite. And this is hedge funds pile into uranium stocks set for dramatic rise. John says, nothing beats the sweet aroma of the uranium mining stocks fireworks for Halloween. Camco's big earnings beat and best ever nuclear demand outlook was definitely a treat. And that's a lot of the companies and their returns for the day. Coming into some of the real estate stuff. The more unaffordable it is to buy, the fewer people can afford to sell. U.S. home prices set record with 7-month streak of gains. That is kind of weird, isn't it? I mean, a lot of people think that this housing market's going to boop, boop, boop. But home prices continue to go higher, not lower. Widespread use of variable mortgage rates and high debt burdens makes some housing markets more vulnerable to rising rates. Obviously, Canada, Sweden, Finland, Australia, Norway, and Denmark are some of those areas where they are more vulnerable. Now, look at the United States. We are way off in the lower corner. And what does that mean? It says the household debt as the percent of gross disposable income is very low. And on top of it, the share of adjustable rate mortgages and new mortgage issuance is very, very little. So when looking at this, United States is basically the lowest risk country on this map here in terms of foreclosures and all that stuff. So the people calling for crashes, guys, cocaine's a hell of a drug. That's all I'm going to say. Cocaine's a hell of a drug. All Things Ventured, he says, disaster is waiting to happen. So what he talks about, the transcript, let's go over this real quick. It says, the Sophie CEO today said, as it relates to loans, we're seeing unprecedented demand for unsecured personal loans. And then True, CFO, last week said, absolute lending volumes remain healthy as unsecured personal loans have become a mainstream product for consumers. So there is loaning, and it's going on the personal level, just to let you guys know. Banks are showing decreasing willingness to lend to businesses, a sure sign of recession. And Jason says, no. For the record, the S&P was higher 4 out of the 5 times 9 months after similar cycles. Small caps were up every time. The stocks do not equal the economy. This is commercial and industrial loan growth has gone negative here. We've got Steve saying, others, you explain there's no rush of foreclosures coming anytime soon, October 28th post, and that people are in fact not falling behind in their mortgage payments, and that unemployment might not be the problem everyone thought it would be. But what about the bankruptcies? I hear many business and people are filing bankruptcy at record numbers. That will eventually cause cracks in the housing market. It has to. Me? Well, actually, bankruptcy is a legal right guaranteed by the U.S. Constitution. Bankruptcy helps people who can no longer pay their debts get a fresh start by liquidating assets to pay their debts or by creating a repayment plan. Bankruptcy laws also protect financially troubled businesses. There are hundreds of thousands of bankruptcies every year in the country. Any surge would indicate that the economy is hurting and may be a precursor to challenges that may impact the housing market. But according to the Administration Office of the U.S. Courts, filings are up slightly compared to last year, but down compared to 2021 and down significantly compared to the 2 prior years. There just isn't a surge in bankruptcies. Therefore, there is no existential threat to the housing market. Just saying. And this is bankruptcies below pre-pandemic levels. Down, 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 down. The guys that are all calling for this gigantic crash in the real estate market, where is it going to come from? Bankruptcies are down, foreclosures are down, checkable deposits are high. Yes, savings rates are coming back down, but that's a rate of savings. They're not pummeling their deposits yet, like they did in 2007. And I'll show you what that looks like in the next few slides. This is Logan. He says 5-unit permits going down a little bit. Single-family permits are going up. The reason for single-family permits rising are big builder buy-down offsets for higher rates. This is one variable factor different now than other cycles. And if you look, you can see on the right-hand side, this is single family in the blue. The 5 or more is coming back down in terms of the permitting for new places. Steve says, oh my God, my warning last night was premature. Sorry. Case-Shiller's numbers just came out and prices didn't show a deceleration of appreciation, but instead a reacceleration as shown by the chart below. It says, I'll take a beating on this post from those who have been calling for prices to drop for over a year. Feel free to follow my responses to them. Hint, many of them are mistakenly looking at median prices. Put their hand on their face. More on this later this afternoon, heading to a big meeting. There we are. Price appreciation is accelerating, not decelerating. And this is generally the slower time of the year. So what is going on here? Generally, we slow down late summer and into winter. Why are we accelerating? What is going on there? Now, this is Game of Trades, and I don't know. I don't know if he's trying to do this on purpose or what, but he says excess savings from post-pandemic in 2020 has plummeted, with credit card debt crossing blah, blah, blah. What is excess savings? Excess savings have likely depleted. So they have savings, but the excess savings have depleted. What kind of data is this? Now, here's my household's checkable deposits and currency asset level. In 2004, you can see that the checkable deposits and currency asset level was declining into 2007. We had very few checkable deposits and currency in terms of asset. Look what we have today. You're telling me that this is a weak market? We've never had anywhere near this amount of money in assets in terms of checkable deposits and currency. Not even close. Not even with a whisker. I mean, guys, this increase from where we are today to where it was in 2007 before that recession, I mean, that's probably like 50 or 70x more. I mean, that is just ridiculous how much money people have in their checkable deposits. Now, obviously, some people may be hurting in the system, but there's just a lot of money that's in a lot of accounts. I'll just say that. So coming on back, we've got the ghost of 1980 is a best case scenario for housing, according to Amy Nixon. I'm more concerned about an appearance from the century-old ghost of 1929. This person has no idea what she is talking about. We just went over that prices are going up. We went over that bankruptcies are at very low levels, foreclosures are at low levels, etc., etc. But apparently the 1929s, which was very similar to the 2008 crash, they were basically coming out of the same playbook, which was reckless lending, reckless crap, tons of foreclosures came, and we had a deleveraging event in the 1920s from the housing market. We don't have the deleveraging. We don't have the foreclosures. We don't have the bankruptcies. We don't have all that stuff. We've got checkable deposits that are, I don't know, up at the moon. What is she smoking? Then we've got the ghost of 1980. 1980, we had massive amounts of inventory in 1980. We had a hyper supply phase at the end of a baby boomers coming into home buying existence. So she fudged the demographics as well. You got to get the demographics right. You got to look at the inventory numbers, and then you got to look at the housing starts, and they're all kind of interconnected. In my opinion, these two time frames, they're not even close to a comparison. I'm sorry. The best comparison, if I were to choose, would be the year 2000. The year 2000 had housing starts decline, like we have over the past year. They also had low inventory levels. Once interest rates went up, the inventory levels were still very low, house prices were stable, and then they had a problem with the tech recession, NASDAQ recession, we'll call it. And that's when they lowered rates and the housing market blew up, and then they basically created all these crappy loans. And those loans went into foreclosures, short sales, all that stuff. And then that is what caused the problem. Sorry, but nice try. Previous 40 plus years have simply been a buildup. What happens next will be truly mind-blowing, says Patrick. Not many times in a lifetime will you get front row seats to a breakout of this magnitude. This is silver. Silver hitting its head again, and we're right underneath it. And we could get a breakout of this trend line that we're breaking here. And then we've got the big horizontal breakout potentially on the yearly chart. This is gold versus inflation on the bottom one. And guys, if we break to the upside here, this is going to get absolutely ridiculous. The size of these patterns are monstrous. We've got a cup and handle on both of these patterns. And we've been just tracking sideways here on another cup and handle, you could almost say. This is like a dream within a dream within a dream. And we've got not just the dreams within the dream of gold and silver. We also have these two in alignment, which is perfect. This is going to be absolutely gargantuan when this thing breaks for silver and gold. Charlie says U.S. home prices hit a new all-time high in August, while affordability has plummeted to record lows. Here's your affordability, and there's your all-time high. Here's silver, another one. I just look at this, left shoulder, head, right shoulder, and this is on a shorter time frame than Patrick's. So this here is occurring like right in here. It's this little teeny area right in there where we have another shoulder. So this is a dream within a, so this is a dream setup within a dream setup within a dream setup within a continuation pattern. Like this is the big kahuna. This is what you look for like the all-time trade of a lifetime. You try to get the entry point on like a right shoulder of an inverted head and shoulders inside of another larger cup and handle, inside of another larger cup and handle, inside of, the big one, which also aligns with further data like the cup and handle on gold versus inflation, etc. So you've got not just the dream within a dream within a dream of a setup, which is your different time frames. You also have confluence among other sectors, and gold, which is another metal. Absolutely beautiful patterns here, guys. Here's another awesome one. This is gold weekly lineup of the chart cup and handle and the potential break of the handle. Guys, this is ridiculous. It's absolutely ridiculous. And I'm glad that I started the channel. I'm glad that we can all share this together. Because when I see stuff like this, it's tough sometimes to sleep at night because the setups are so big. And again, it's a dream within a dream within a dream for the setup on different time frames. And that's what you want. You want all the time frames to align. And again, this is more confluence of evidence because I'm looking at all these in US dollars. When we look at all this in different currencies, different fiat currencies, guys, look at this. Gold ripping against Australian dollar. Gold ripping against the Canadian dollar. Gold ripping against the euro. And gold ripping against the great British pound. Great Britain pound, whatever you want to call it. Peter Schiff says, over the next 3 years, 50% of the 34 trillion national debt matures. During those years, budget deficits will add at least another 10 trillion. If the government pays 5.5% interest on that 27 trillion, ignoring the other 17 trillion, the annual interest cost will be $1.5 trillion. And then we go and look at all these charts at gold and silver that are just absolutely massive. This is such a ridiculous setup, guys. It's so ridiculous. Here's Tavi. He says the aggregate weight of Apple and Microsoft in the S&P 500 index is now larger than 4 sectors combined. What a bubble. These two companies have been responsible for nearly 40% of the market capitalization gains this year and currently constitute a staggering 20% of the NASDAQ 100. So those two companies, Apple and Microsoft, are larger than the entire sector of energy, real estate, utilities, and materials sectors combined. That's just stupid. It is so dumb, guys. This setup here is so ridiculous. When this unwinds, it's such an opportunity. And the risk that you take with gold and silver is so stinking low. Here's Grady. Like silver, also platinum is sitting right below a huge blue breakout line. And also like silver, a monthly bullish reversal right on big support. Generational breakout incoming. Get ready for the greatest commodities bull ever, ever. And we're setting that up in platinum. We're setting that up in silver. We're setting that up in gold. We've got a dream within a dream within a dream. And the fractals are all the same too. This fractal blue one is the same as this fractal with 1, 2, 3 consolidation. We've got the mover upward and it's just waiting to break. God, this is good, guys. God, 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 God. Despite a drop in crack spread suggesting of weakening demand beyond seasonality, Rystad's real-time cube shows demand inflecting upwards, which is very contrary to the current bearish narrative, and this deals with oil demand. Global product demand growth is going up, not down. So, again, guys, when I look at all of this stuff, the setups here are so good, and the alignments are so great. They are so great. So we got the housing market. Here's a couple things I want to talk about. We got the housing market. The housing market as it goes up, that is putting the pressure on interest rates. Interest rates are not the driver. The demographic is. The demographic interacting with the real estate markets, one of the main drivers. It's going to kick off tertiary things around us. So that's the main driver. It's going to kick off a debt crisis, perhaps. And then interest rates are going to react to the demographic and the inflation of increasing interest rates. Those increasing interest rates are going to rotate money at this stuff. How do I know that? Why? How does this guy talking on the internet on YouTube, how do I know that? Well, this is how we validate it. We know where all the money is and isn't using the ratios. It's all over in financial stocks. Microsoft and Apple is larger than 4 frickin' sectors of commodity sectors, energy, materials, and stuff. That's ridiculous. That's a huge imbalance. Huge imbalance in the markets. So we know the money's over in financial assets. It's unwinding out of bonds right now. Big time. You can see it TLT dropping. We're also seeing the stock market kind of slow down. Usually it goes sideways to slightly lower in these types of time frames with increasing interest rates. The money then rotates over into our stuff. What do we see in the chart patterns here, guys? What do we see? A dream within a dream within a dream on different time frames on silver and gold. A dream within a dream within a dream. A dream on the short term, a dream on the midterm, and a dream on the long term. Best possible entry point, period. Period. Then you can take that bet with the least risk possible in the physical metals. Guys, this is like handing you an opportunity. Here, I'll put the ball up on the tee. You just have to hit the ball. That's it. And we're seeing all of these patterns in the ratios play out too, like the producer price index versus the S&P 500. It's starting to come in favor of producer price index. We're starting to see commodities outperform financial assets. They're starting to come on up and outperform. Everything is in full alignment. I can't see anything where it's completely jacked up. Now, people can talk about the housing market potentially going down and all that stuff. The data does not support it. I don't see where the weakness is. I don't see the forced selling. At least not yet. I don't see it. Just because I don't see it doesn't mean we can't have a recession. It's just it would be a slowdown from something else other than the housing market. Now, if that something other does come, and if their response is to lower rates, they're going to send the housing market up. It's going to be like it's not even going to be like the 1970s. It'll be like the 2000s, because the real estate market has a lot of buyers. They're just priced out of the real estate market, which is holding it all down. Which is it's the affordability that's holding everything down at the current time. But we're still going up, and it's out of season too, which is kind of weird. The houses around my area, I know this isn't a huge thing, but they're selling. They're usually on the markets for less than a month, and then they're gone. So it's still going. I don't see a slowdown yet. Yes, I should say, they have slowed down, but it's not a recession slowdown is what I mean by that. They have slowed down. It's not a recession slowdown where we're building inventory everywhere. So that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel. And again, if you need help with anything, check out finding-value.com. You can still use the word discount to get a discount if you're interested. All right, guys, we'll catch you later. This is Finding Value.